This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning and we are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Morning, guys.
Hi, good morning, Prashant. Good morning, Nigel.
Morning.
Well, after yesterday's steep fall that we saw, it's going to be interesting which way things go today. Of course, lots of pockets like PSUs, etc., have been under pressure. So a reality check, so to speak, for the market. But let's see. Today, the implied opening is suggesting a bit of green.
Well, indeed. And let's hope we can build onto that because yesterday was a weak session, to say the least. And on the flip side, guys, at least weather is really good, right? In Mumbai, in February, I'm not seeing, I don't think in the last many years, it's been so pleasant.
Chilly.
Yeah, chilly and pleasant.
So let's hope that also stays good.
Yeah.
But weather in the markets is what we are here to kind of quickly assess in terms of how things are likely to be. And, yesterday we'll come to the Nifty, Bank Nifty and the indices, the frontline indices in a bit, but the broader markets. So yesterday was the first big crack in the PSU rally after a long time since the rally actually began. Perhaps the single largest day sell-off in the PSU index in the recent history. 4.5% gone there on the CPSE Nifty index. Remember, last Tuesday, and of course, we kind of mentioned it last Tuesday, but I guess the numbers would have been around the same. The weekly RSI on the CPSE index had hit about 95. Even if it had dropped to 90, even 85, anything over 70 is generally considered overbought. We were running at 95. So some cool-off perhaps was in the order of things, and it's impossible to know when it'll come. Yesterday, it came. Violent sell-off in many names. It's a long list yesterday, and we'll put some of these names out in a bit. I think about 6-7 names which sold off about more than 15%, and I think about 15 names which sold off more than 10% each. So pretty violent out there is what we saw. I'll tell you what, in a typical sell-off like this, like the one that we've seen yesterday in a sector which has done so well, the people who sort of try to sell the first, who'll sort of exit out of the doors, the first thing whenever there is weakness are people who have probably just gotten in the last leg, right? Looking at momentum, really no conviction in that sense, but just to play for the gains because they were coming so easy and so fast. And that is the shakeout which kind of exacerbates and it becomes a 3-4% kind of a cut on the indices. That's what I think we saw yesterday. If you're wondering if yesterday was exceptional, was it exceptional? Actually, it's not exceptional because every month, this is actually the Nifty small cap index that I'm talking about. Every month except November, we've had a between 3 and 4% correction, at least in one single day. Actually only one day. Look at that. In sort of February of, going back actually all the way, September of 2023, October of 23, December of 23, and of course yesterday as well, we had sharp sell-offs which came through. And then of course the market repaired and started to move higher. The question is, will we see something similar or it's going to be a little different? My sense is perhaps there is a little bit more in terms of pain left, some more consolidation because yesterday was just the first day when that reversal actually started to happen. Now let's just address the global stuff, right? Very quiet, not very much new in that sense. The S&P was down absolutely flat. The Nasdaq was absolutely flat. Actually, it's almost unchanged. The 10-year yield, 4.18, dollar index 104, nothing really. Oil prices holding at 82. It's almost as if you can pick up the session from last Friday in the US and not very much would have changed. Tonight, you get the US CPI numbers, which perhaps will get you some indication, at least in the very near term, about what the market wants to do next. Yesterday, for example, we were asking the question whether the market is starting, at least in the US, starting to treat good news as good news and not something to be afraid of. So I think it'll be interesting to see that. On the Nifty, just to circle back on the levels, we broke Friday's low and we also ended below the 20-day moving average yesterday. The next, in a way, target, so also becomes a support naturally, is the 21,450 kind of level. 458 is the exact level. This is a 40-day exponential moving average. It's not very far away, 150 points out from where we are. Hopefully that will be held and the market consolidates without further price damage. But if that is broken, you're looking at a deeper pullback. Bank Nifty broke below Friday's low as well, and the fall perhaps may be extended. We've been talking about that 44,429 level that is very close by now. and that is the recent sort of swing low that the market had. And then roughly 44,000 is where a few other supports come in at. So that's a very near-term picture on the Nifty Bank. And of course, on the way up for the Nifty Bank, because it's underperformed the Nifty, the 20-day and the 40-day are the resistance levels. But I mean, the advice is just wait, let the market cleanse itself out, maybe a day, 2 days more, and then start to look at opportunities once again. It'll give you enough opportunities. There's no real hurry. The GIFT Nifty is indicating about a 50-point higher start. Sonia.
Absolutely, and today is going to be an action-packed day because everyone's going to want to know what's happening with the PSUs, right?
Indeed.
Yesterday, you saw there was profit booking across the PSU stocks. So the Nifty CPSE index, the PSU Bank index were down about 3% apiece yesterday. And there was, weak earnings, which sort of put a bit of a reality check in many of the PSU names. There was high delivery-based selling in many names yesterday, whether it was NHPC, IRFC, SJVN, delivery selling of almost 800 crores in NHPC, 500 crores in IRFC, and about 400 crores in SJVN as well. However, this morning, there are strong numbers that have come through from a couple of PSU names, whether it's Coal India, whether it's SAIL, good numbers that have come through. So I'm going to be very interested to see the reaction to those earnings. If the street reacts to it well, then perhaps, the worst is over for the PSU space. You never know. But if there is selling pressure post these numbers yet again, then you know that, the PSU rally might be done for now. Defensive spaces like IT and Pharma are doing well. In fact, Nifty IT and Nifty Pharma index are up 4% this month. So definitely when the market is cautious, they move towards these defensive spaces, and these are sectors to look at. There is that MSCI rebalance that will lead to inflows of around $800 million to $1 billion. So keep an eye out on that. And on the Nifty, the next level that I'm watching is that around the 21,460 odd mark. So keep a crucial eye on that level on the downside. In terms of flows, the buying continues both from domestic and foreign institutions. So yesterday, DI has bought about 1,700 crores, FI has bought 126 crores. But I'm going to watch out for a lot of stocks today, especially names like Paytm. There's a big downgrade that has come in from Macquarie this morning where, they talk about the risk of a mass customer exodus from Paytm, and hence there's a huge target price cut. They've cut it to 275 from 650 earlier, so that's not looking good at all. So plenty of stocks in focus, but toss it across to you, Nigel. What are you looking at?
Well, Sonia, a quick point on that MSCI emerging market, right? India's weight has gone to around 18.2%. Just around a few years ago, we were at around 8 to 9%. So that's really the big, weightage increase for India in the last few years. A quick recap of yesterday's highlights, though. We were saying that the institutions didn't sell, right? But the FI participation itself was 40% low if you compare it with February averages, looking at the gross volumes itself. Next up, it appeared yesterday there was a bit of a reallocation that took place. That is, movement from some of those broader market stocks to some of those larger cap names, namely IT and Pharma yesterday saw a good amount of flows. And the third point for me was the Nifty Bank had a weak session. It ended closer on the 200 DMA. In the past, we saw it bounce off here. You don't want to decisively break that. Otherwise, in fact, we'll be bracing ourselves for a deeper correction. Let's find out what happened yesterday. We ended lower, and the FIs, they have added some long short positions. Not very, very large. No, there wasn't any big shorting out there, but the short positions are at around the 66% odd mark. The PCR, though, has come down to around 0.85. So it's a distance away from that 0.7 odd mark because there was a call writing that we saw yesterday. You had the 21,700, 21,900 call. Both of them did see a fair bit of addition. Which brings us to the levels. Going by the options data, going by the technicals of the market, well, the 20 DMA, that's the one that got breached yesterday. Now, all eyes are on the 50 DMA. I'll tell you what, most traders are positioned that we won't see a level that breaks this 21,000, 21,100 odd. Though in the near term, that's the support level you're looking at. On the Nifty band, the 200 DMA, well, we ended closer to that mark. But the recent low that I'm looking at is at around 44,400 odd. And the Nifty Financial Services Index, well, that plays out the weekly expiry as well. Two stocks I'm looking at, one on the upside, one on the downside. Now, yesterday, the PSUs came in for a smack, but Coal India, the numbers look very, very good out there. India's entire economic growth will lead to higher power consumption. Higher power consumption means higher demand for coal. So they have volume growth in place, and they have cleaned up things quite a bit, on the operational side of things as well. So Coal India is a stock that I'll be looking at because it corrected close to around 5% yesterday, expected to open up in the green. And on the flip side, Hindalco is a stock that I'll be looking at on the downside. Remember, the street doesn't like any big capex announcement. They'd already announced some capex. Now they've gone ahead and they've upped some part of that capex. So the numbers on Novelis were in line. The problem is the capex guidance is something that will spook investors. So I'd like to see how much such stock corrects in today's session. But let's see how this goes, guys.
All right, thanks a lot for that. So plenty of stocks in focus as we kickstart a brand new day of trade. On the equity side, here's what you'll get to see. Vikas Jain of CLSA says despite the $3.6 billion of buying, the ownership of FPIs in Indian equities fell close to a decadal low at the end of December 2023, while much stronger inflows from domestic mutual funds took up their ownership to a new high. He adds that both foreign FPIs and domestic funds moved from large caps and mid caps to small caps. Vikash notes both notably, cut weight in banks, autos and industrials, while moving into NBFCs, staple, energy, healthcare and IT. FPIs also turned neutral on NBFCs from underweight. FPIs and domestic mutual funds had notable divergent views on HDFC Bank, Maruti, L&T, Axis Bank and Infosys, while their actions were the same on Reliance, Bajaj Finance, HUL and IndusInd Bank.
Okay, well, let's get you some money market views as well. This is Abhishek Goenka of IFA Global, who says that they expect the flow picture to be favorable for the rupee. However, the RBI is likely to continue mopping up dollars aggressively, thereby putting a firm floor under the dollar-rupee pair. He expects the rupee to trade between 82.7 to 83.4 that's a cross-currency, and volatility to continue to remain under check.
All right, and on the bonds, you have Vishal Goenka of IndianBonds.com saying the CPI series came back lower at 5.1% last evening, with realized inflation lower than forward guidance post the somewhat bearish RBI policy last week. He says the next few will come from CPI numbers in the US tonight, followed by important wage inflation and growth readings from UK and Europe later in the week. He expects the 10-year benchmark bond yield to trade in a range of 7.07 to 7.12%.
Well, a lot of stock-specific action track for you. We get to that in just a bit in our special Top 10 segment. For the time being, we run you through the list, looking at Coal India, the Bilcon, Phoenix Mills, Time Technoplus. They will be reacting to positive news flow, but you have Hindalco, Bharat Forge, SAIL, HEG, Galaxy Surfactants, as well as all cargo logistics that will be reacting to negative news flow.
All right, well, that's what's coming up in terms of specific stocks we will address in just a bit from now. But Phu Kin Yap is Senior Investment Strategist at Standard Chartered Bank. He's joining us now to take some questions. Phu, great to have you with us here. Thank you for your time. I'm not sure if you watched closely what happened yesterday. I mean, the market shook out, especially in the broader markets, in a pretty large way. 4% fall in the broader market. That's small cap index, mid cap index, and of course the PSU space as well. If you did, I mean, do you think there is more to go here? What's the view?
To be honest, I did not watch it very closely, but I can say that within our India strategy outlook, I mean, India is a very core holding for us. What our preference is with the large caps in India. We think it has a higher margin of safety, and that is actually reflected in our sector strategy as well. We have a bit of a barbell approach when, on the one hand, we like your cyclical sectors like industrial and discretionary, but then on the other hand, we also want to balance it with healthcare, which is a bit more of a defensive approach. So yeah, our preference is still with the large caps this year.
All right, preference is still with the large caps. Fook, in the Indian market, there is a wave of profit taking or a sell-off that you're seeing after a massive rally that this market has had over the last many weeks and months. What is the best way to approach the market now? Sit on cash levels, book your profits, or would you continue to buy the dip?
No, I think we do think that equities and bonds will deliver better returns than cash this year. So cash has its place, but we think that, with the wind that's blowing behind equities and bonds, we do think we would be more underweight in terms of your cash allocation at the moment. I mean, with the equities, we think earnings will continue to be positive and economic growth in India. That's positive to stay invested over time. And with the bonds, especially in the medium to longer term, bonds, we think they are more attractive. They can deliver better returns than cash because, I mean, cash yields are attractive compared to historical levels. But if you look at bonds and where we expect bond yields to come down steadily over the rest of the year, we think that will be beneficial, especially for medium to long-term bonds. And that's why we do think that bonds can outperform cash. So it is really a situation where we look at some kind of correction. It'll be an opportunities to buy. And we see that as well, actually not just in India, but in the US as well. We do see some technical indicators showing slightly overbought. So we would trim some of our allocations, take profit of the gains year to date. but still maintain an overweight position because we still do like global equities, still do like US equities and India as well. Yeah.
All right. Hi, Fook. Good morning, Fook. But on India, I think between India and the United States, I think your preference is towards more developed markets, in the Japanese market, the United States, and then India, right?
That's right. That's right. Yeah. So India is as a core holding within Asia and Japan, but because we are overweight on global equities, so India would be part of that.
All right.
But in terms of the preference, yeah, our preference is with US and Japan. And then within Asia, Japan, our preference is for Korea at the moment.
All right. We got that. Thank you very much for joining us, Fook. It's a pleasure having you with us here on CNBC TV18. Thanks indeed. Well, let's address some important macro data. I mean, the RBI meeting yesterday, of course, was the focal point, and inflation is, I think, one of the sort of important things that many are watching for. So retail inflation remained steady in January. That's the latest data which came in and was a tad above CNBC TV18 expectations. Meanwhile, industrial production numbers have also grown by 3.8% in December, higher than estimates. Lata is here with a quick take. Lata.
Well, actually, both data are good for the stock markets largely. Let me start with inflation at 5.1%. It's, yes, a tad higher than the 5.03, which our poll threw up. Actually, many on the bond markets were working with 4.9 something, sub 5. Psychologically very important if it is sub 5. So for the bond markets, this could be a bit of a disappointment. But if you looked at the internals, it's actually good for industry because core inflation is down to 3.6. That's a multi-year low. And, the RBI's diktat itself is to keep inflation at 4%. So core is an important part. That's the only thing that's influenceable by interest rates. Core is all the items excluding food and fuel, which are kind of beyond interest rate reach. They are more supply side issues. And therefore, core coming down to 3.6 means the Reserve Bank's job is done. To that extent, and it also is a direct input into industry. And therefore, industry should be happy. Corporates should be happy that core inflation is down. And the Reserve Bank, to that extent, should be on the front foot in terms of reducing rates. But the real problem is the next number, which is food inflation. Coming in at 8.3, it's higher than the CNBC TV18 poll of 7.4, lower than December's 9.5, but 8.3 is by itself a bad number. And it's bad for RBI, bad for government, bad for FMCG companies. I'll start with FMCG companies. A lot of the food items, especially cereals, that's the one that's up about 0.8% month on month and 8% higher year on year. Now, that's an input into several FMCG companies, for cereals and such other makers, food items. As well, if consumers are spending a lot of money on food, there is less to buy smaller FMCG items. So consumer non-durables are likely to do badly. And therefore, this is not good for them. More generally, for the Reserve Bank, you're in a dilemma, you're in a bind. Core inflation, which you can control, has come down, but food inflation, which is somewhat beyond your control, is going up, and we are an outlier here because the global FAO index, the Food and Agricultural Organization index, is actually falling. So this is a bit of a dilemma. Reserve Bank can't do anything about it. They cannot cut rates unless food inflation behaves itself, and this is becoming intractable. Politically also a difficult one. So overall, that way, there are negatives from the CPI number, but positive for the corporate sector. A word on the IIP number, that's come in 3.8, higher than our poll of 2%. Within the internals, capital goods has gone down. So it clearly looks like the CapEx cycle is taking a bit of a breather in the last few months in the run-up to elections. Election is also down, but that's also a bit of a base effect. Consumer non-durables is a bit lower. Those would be the weak points. But overall, IIP, we give less importance because this is a December number. You already have all the corporate results. So this is not that important an indicator of health. It's CPI that's more indicative of the health. Short point, okay for industry. The news is good, but not good in terms of policy expectations.
All right, thanks a lot, Lata, for that. Let's slip into a quick break. On the other side, we have a long list of stocks to watch out for. More on that coming up in a bit. Welcome back to Bazaar Morning Call. Plenty of stocks to talk about. So very quickly, let's get our entire research team to tell you about that list. Some of the PSUs reported good numbers this time. Coal India was one of them. Good set of earnings.
Well, very good set of earnings for Coal India. And the good news is that, in fact, yesterday the stock was under pressure. So there's no preempting the good results. Top line was a beat. Margins as well much better. The key reason was that you had the blended realizations that came in a little bit better. FSA prices, well, they went up because they had taken a price revision in last year in May 2023. So that's what reflected. But the better news was that the e-auction premium to FSA, that spiked up on a quarter-to-quarter basis. So in the previous quarter, it had gone down to around 85% odd. So that came in as a bit of a pleasant surprise, and that's what led to the beat. You had cost as well that are under control. The stripping activity cost, well, that came in lower, but that's a non-cash expenditure. The profit number was higher, supported by other income. Stock trades at single digit, 8 times PE, and has a dividend yield of around 6%. Expect the stock to bounce back in today's trading session.
Okay, that's on Coal India. But what about Hindalco?
Well, Hindalco's numbers actually, Sonia, were pretty okay. That's the Novelis's numbers. So the adjusted EBITDA per ton at close to around $500 per ton. They're also talking about going to $525 per ton for Novelis's operations in Q4. And they're saying gradually they can scale it up to around $600 per ton. So all that's fine. The problem is that the net debt number has moved up because they have a big capex plan underway. And the biggest problem about these numbers is that they've gone ahead and increased their capex for one of their plants. They are in, currently they are setting up a 600,000 ton plant out there. Earlier, they had guided that the capex out there would be around $2.5 billion odd. Now they're talking about $4.1 billion, which is a capex increase of close to around 60% for a single plant. And they've also said that the project now will start in the second half of calendar year 2026. So that's a little bit delayed as well. So this big capex spikes is something that will spook the stock. So expect the stock to open up in the red.
Okay, and one stock that had a big fall yesterday was Bharat Forge. So I'm watching out for that one. A lot of brokerages have come out and cut their earnings estimate and target price on the stock post the numbers in the weak commentary from the management yesterday. Citi has a sell. They've cut the target price to 800 rupees from 900 earlier. CLSA has a sell with a target price of 977. Jefferies has an underperform with a target price of 950. Remember yesterday in closing bell, the company told CNBC-TV18 that Europe is seeing heavy cost increases because of geopolitical events in its vicinity, and many export markets are seeing both a moderation in growth as well as a slowdown. Now, yesterday there was large delivery selling that took place in Bharat Forge, about 238 crores of delivery selling in one day, which is 5 times its 1 month average. The F&O turnover was also the second highest amongst all the stocks, and there were fresh shorts seen in the system. The open interest change came in at over 12%. So I'm going with red. You could see some incremental pressure on Bharat Forge this morning. But sale is what you're looking at as
I'm going with red out there, Sonia, because those numbers at the face of it appeared pretty much in line, the EBITDA number. But the problem was that the top line was a little bit low and the volume decline was to the tune of closer around 8% odd. So the EBITDA number and the operational performance looked okay. But there was one provision that they made out there. The top line could include the provision on account of a rail price revision. A couple of sales notes have mentioned that that's the reason why the numbers are in line. X of that, it would have been lower. Well, a couple of other brokerages have written that, in fact, this is not included in these numbers itself. So we'll have to wait for clarity on that front. Though the gross margins did come in higher, which, was the reason that EBITDA number got some backed up. But the reason I'm going with red is adjusted numbers don't look very, very good. The sales volumes numbers were lower, which means they have some inventory built up in their system. And the gross debt number as well did move up. So expecting it to open up in the red.
Absolutely. And I think SAIL is also now been included in the MSCI small cap index.
Oh, that'll be good for them.
That'll be good for them. So some buying support perhaps at lower levels, perhaps also at play. But Nigel,
and also the other one is that, yesterday you had already had the stock corrected from 150 to 122.
Yeah, absolutely.
So if there is some bad news, some part of that is already in the price.
Absolutely. But it's a long list of stocks for you, Nigel. It's almost a slam dunk. Go on, HEG.
Extremely busy morning. But, HEG's numbers actually were disappointing. The longer term story is very, very good because there's going to be more of EAF, electric arc furnaces that will be set up globally. So graphite electrodes will be needed. But these numbers still, they're not very, very impressive. Top line, a small growth out there. Operating profit was down by close to around 35%. Margins, well, they came in at the lowest we've seen since March 2021. They've come in at around 15.5%. The management has said we're close to bottoming out, but maybe not as yet. Maybe from Q4 onwards, we'll see that. So going with red on this one, though yesterday the stock was down close to around 7%.
All right, that is on HEG. But Galaxy Surfactants is the other one that came out with their earnings. Sonal is here To give us the lowdown, Sonal, over to you.
Good morning, Sonia. It was a weak set. The revenues declined 13%. The EBITDA was down 25%. The margins also came in lower by around 200 basis points, leading to a profit decline of 33%. In this quarter, EBITDA was also aided by a 20 crore rupee export incentive in Egypt, which was booked in the quarter. The underlying volume growth, however, was at 8.4% in 9 months, which is higher than the guided band of 6 to 8%. But EBITDA per ton was lower than the guided band of around 19,500 to 20,500 rupees per ton. So it came at around 18,800 rupees per ton. However, they did say that the Red Sea escalation did dampen sentiments in the second half of December, and this is the biggest risk going forward. So more light on that is something we'll read. But yes, overall, weak numbers.
Okay, overall weak numbers from Galaxy Surfactants. Well, let's hop across to Vivek. He's tracking Dilip Bilkon this morning. Vivek, over to you.
Well, good morning. It's a steady set from Dilip Bilkon this particular quarter. Debt reduction has also come in. This was on back of the deal that the company announced with Alpha Alternatives in Q2, and thereby debt has reduced. Now, looking at the numbers themselves, quite a steady set. Revenues higher by 24% on a year-on-year basis, coming in over the 2,870 crore mark. EBITDA aided by lower raw material costs, aided by lower other expenses, but marginally impacted by higher other expenses was something that actually aided the EBITDA growth, higher doubling on a year-on-year basis. Margins too very strong, 12.4% versus 6.8%. Profitability, however, was down 3.2%. Total order book this particular quarter has marginally moderated compared to Q2. Total order book coming in at over 21,840 crore. Order inflows for the 9 months of FY24, well over 2,140 crore. Expect the stock to open in the green today.
Okay, all right. Thanks a lot for that. Vivek, going back to Sonal. Sonal, tell us about Phoenix Mills.
The P&L looked really good for the company. In terms of revenues, it was a growth of 44%. EBITDA grew 44%. Their margins were flat at 56%, but the profits grew by around 70-odd%. Their free cash flows have also come in at an 8-quarter high at 536 crore rupees. In terms of their operational update, their retail consumption was up 25%, which is with the new malls. But on a like-to-like basis, it was up just 5%. In fact, their biggest mall, which is Phoenix Palladium, saw 2% decline in consumption, quite telling about the demand trends going forward. But yes, the P&L was good and free cash flows also coming in at higher levels.
All right. Sonal, thanks very much for that. More numbers, Time Techno Plus and All Cargo Logistics. Upasana's got more. Upasana.
So first up, let's talk about Time Techno. The company reported a strong Q3 with a volume growth of almost 20% on one-year basis. Revenue also saw an uptick of almost 17% on one-year basis, and margins also sharply expanded by 100 basis points at 14.5%. In terms of PAT, the growth we saw an uptick of almost 50% and stood at around 92 crores. Next up is All Cargo Logistics. The company reported a weak Q3. That's why we are going with a red on this stock. The revenue saw a downtick of almost 22%, and EBITDA margins were also under pressure, stood at 3.5% versus 6.1%. While the company says that the international supply chain business has bottomed out and performance nearly remains flat sequentially. The performance was mainly impacted by significant losses, mainly in US and Germany. And in terms of volume growth also, it remains quite flat on one-year basis, and there has been a marginal decline of 1% on FCL volumes. So all in all, we are seeing a weak set coming from All Cargo.
All right, thanks a lot for that. So long list of stocks in trade this morning. Here's a quick recap in case you missed out on any of them. Stocks with positive news flow, there's Coal India, Dilip Bilkon, Phoenix Mills and Time Techno Plus, while stocks with negative news flow, there's Hindalco, Bharat Forge, SAIL, HEG, Galaxy Surfactants and All Cargo Logistics. Let's take a quick break. On the other side, Amnish Agarwal of Prabhudas Lilladher will be joining in for some fundamental stock analysis. Later, we'll connect with Unnathan Shekhar of Galaxy Surfactants to talk about their Q3 performance. Stay tuned.
Welcome back to Bazaar Morning Call. Well, yesterday we had a bit of a rough session, but today the GIFT Nifty is suggesting that we pull back close to around 50 points. The hope is we can build on from these levels. Abneesh Agarwal, Head of Research at Prabhudas Lilladher, joins us on the show. Hi, Abneesh. Thanks so much for joining in, Amnish. I want to talk about one of those stocks actually, which could be in focus and was down yesterday because it's part of the PSU basket, Coal India. The numbers do look good. The stock, even after the big rally that we've seen, is trading at around 8 times, and it has dividend yield of close to around 7%, 6 to 7%, depending on what dividend you're assuming. How would you approach the stock at around this 430 level?
Yeah, thank you, Nigel. You see, Coal India, if you look at not only Coal India, I think many of these PSUs, they have seen a very sharp run-up in the past, say, 6 or so. Now, while the performance has been good, and given the fact that India has got a lot of still scope to increase the production of thermal power, we believe that the government focus will continue on increasing the production of the domestic coal, which will actually benefit Coal India. But having said that, the kind of rally which the stock has seen, say, in the past 6 months or so, I think there is a probability of the stock taking a pause, and the incremental returns from here will come at a very moderate rate. And I also don't rule out that the people who had entered the stock early in Coal India and in many of the PSUs, we don't rule out that some profit booking might emerge at this point of time.
Amnish, hi, good morning. What went so wrong with Bharat Forge yesterday, you think? I mean, of course, the management commentary was on the weaker side, but did it really warrant a 14% fall in the stock? And what do, investors do now with this one?
I think there were concerns that your volumes might be tepid going forward. And even I think in the domestic market, there was miss on the sales front. So that I think might be one of the reasons for this stock getting, you can say, a very sharp sort of a correction. But having said that, I think the company has, I think, conveyed that there is not likely to be any growth. That is number one. And secondly, if you look at, say, next couple of years projections, the stock is trading at around, say, 23, 24 times on our estimates of FY26, which if you look at historically for Bharat Forge is not on the expensive side. So given the kind of cut which the stock price had seen yesterday and the management commentary later, I don't see some bounce back in the stock happening today.
Okay, all right. Amnish, I also wanted to ask you about Hindalco. Novelis's numbers were pretty okay, and they're guiding for better times ahead. Novelis's numbers, the EBITDA per ton came in at around $500 per ton. For the next quarter, they say it goes to $525, and from there it goes to $600 per ton. So no worries on operational front. The problem is on that 600,000 ton unit that they're setting up in the United States, from an initial capex of around $2.5 billion, now they're talking about $4.1 billion. That's going to spook the street. What's your view on the stock?
The increase in the outlay for that plant is very significant, from $2.5 billion to 4.1. And basically, Hindalco, although Novelis is more on the value-added side of the product, but even then, your IRR of that project will definitely come down and is going to have hit on the stock price in the near term. In the long term, as far as volumes are concerned or other structural factors, they remain intact. But I think it is going to definitely have some impact because your cost increase is too steep from 2.5 to 4.1. It is more than 60% higher, which will definitely going to, you can say, impact the return ratios and all the parameters of that project.
All right, Amnish, just stay on. We have a management joining us now, so I invite you to listen in as well, and then we'll get a quick comment from you. Galaxy Surfactants is the stock that we're talking about. It reported a weak quarterly performance in Q3 on the back of the Red Sea tensions. Their profits have declined, the margins have contracted. Unnatan Shekhar, who's the managing director at Galaxy Surfactants, joins us now to talk about that. Mr. Shekhar, hi, good morning, and thanks for joining in. In 9 months of FY24, I think you've done about 8.5% volume growth. But I just want to understand, since, a lot of things have sort of escalated since then, the Red Sea tensions have gone up as well. What do you think you can do in the last quarter in terms of volume growth? And for FY25, what are we looking at?
A very good morning to you. See, this quarter and this year has been a growth year for us compared to the last year. So we have, for this 9 months, grown on volume by 8.5%, more than the band that we indicated at the beginning of this year. Particularly this quarter, we have seen growth in volumes across all regions, apart from India, which has been a very, very strong geography for us for now quite some time. So we have grown, barring North America, we have grown on all the geographies. This talks about revival of demand and coming back of consumption in the various geographies and markets that we operate. So yes, the Red Sea remains a red flag for the coming period, but we have seen even demand coming back as far as North America is concerned. So as far as the coming year is concerned, we are very optimistic and buoyant about a growth in a band of something like 8 to 9%. So we do believe that we should see the resumption of demand in all the geographies in the coming year.
All right. Hi, Mr. Shekhar. Good morning and good to see you. In Nigel on this side, you're sounding a little bit more optimistic this time than I think the last time we chatted. So this year, you're guiding for around an 8% growth, 8 to 9% growth. And on that base, you're saying volume growth will be another 8 to 9% in FY25. Is that correct?
No. We are talking about a volume growth compared to this year. You're right.
Yes.
This year, we would close at something like 8.5% for this entire year compared to 22-23. And we are confident that we should be able to have another 8 to 9% growth in the coming year.
Got it. So one key number is out of the way. That's the volume growth. What about the EBITDA per ton? Normally you were guiding for that band of around 19,500 to 20,000. Right. For the past quarter, it's a little bit lower than that. But you have given some commentary that FY25, it could be at the upper end or even beyond that. So what should be the rough number we should work with for FY25 on the EBITDA per ton, if you want to give us a range or a number?
Yeah. See, we have fallen short as far as this quarter is concerned. But we would indicate the EBITDA band at 19,500 to 20,500, which you have indicated previously. And if you look at this particular quarter, there have been certain one-offs in the quarter 3 of 22-23. Among the major one-off which was not available or which was not there this particular quarter was the export incentive that we had received in the Egypt operations in the quarter 3 of last year, which amounted to approximately 21 crores or so, which didn't figure as far as this quarter is concerned. So otherwise, we have seen all-round performance increase in not only various products and various geographies. We have seen growth in Asia Pacific. We have seen growth in rest of the world, and even the Africa, Middle East, Turkey region. Sure. The exception has been North America, which is expected to come back in the coming quarters.
So you're saying that you will hold on to this band, right? 19,500 to 20,500. All right, got it. I'm asking because of the freight rates, because of the Red Sea situation. Just wanted to understand how much have freight rates gone up and what impact would that have on your business?
The freight rates have gone significantly. And we would obviously strive to pass it on to our customers. But then compared to the previous years where the freight rates were normalizing and coming down, we have again seen an increase in freight for various regions. That is one. And number two is that the supply chain has got extended because most of the ships have to pass through the Cape of Good Hope because they can't pass through the Red Sea. So the supply chain, the time has got extended, which we have to factor very well in the coming period. What is important and significant for you to know that we have been, the way we have managed supply chain resulted in us being acknowledged with Excellence Award both by Procter & Gamble as well as Henkel. This is something which is very, very significant, talking about our capability in terms of responding to our customers' demands through the various supply chain measures that we have taken up.
All right. Okay, we will let you go on that note. Thanks a lot, sir, for joining in and speaking to CNBC-TV18. That is Galaxy Surfactants. Their margins have contracted this time around, but they hope to hold on to the guidance that they put forth on their EBITDA per ton. Well, for the market, the GIFT Nifty is indicating a start, which is about 50 points in the green. But yesterday was a very, very disappointing day for the market. Huge sell-off is what we saw in PSUs. Anuj is joining in now to give us a quick snapshot of what to expect. Anuj, tricky days, right? I mean, large sell-offs seen in spaces like PSUs. Defensives are once again picking up pace. What have you made of it all?
Yeah, morning, Sonia. Not surprising. You'll remember yesterday, in fact, that was our key theme, that there could be some big correction in PSUs. Now, there are three things that I'm tracking today. It's an asset test for the market. The first one and most important, perhaps, is the Bank Nifty, which closed once again right at the 200-day moving average. The Nifty, which has been quite weak, yesterday closed below the 20-day exponential moving average. So that's two crucial levels to watch. I think today is also a test of PSU rally because you have some really strong numbers, especially from Coal India and from SAIL as well, decent numbers. So today will be a test of the PSU rally, whether it's indiscriminate or at least the market's willing to make some difference and buy some good PSUs where the numbers are strong. I think that's something that we'll find out today. And of course, as expected, some PSUs were included in MSCI index. So in that sense, there's at least some positivity today. But if Coal India and SAIL fail to rally today, then that will be a big negative. The Bank Nifty is extremely weak. Of course, it keeps happening. It keeps seeing these short covering moves like it saw last Friday. But those are really suspect moves. Right now, the best place to be in is IT and Pharma. Both these indices are up 4%. And you can just look at the index and make out that this is the space where at least you're making some money. Coming to levels then, on the Nifty, the first resistance is at 21,686, the 20-day exponential moving average. And then the call writers zone, 21,832, which also, by the way, perfectly coincides with yesterday's high. On the downside, the first support is 21,500, which is the option writers zone, put writers zone, and 21,429, which is the series low, below which I think the market becomes very weak. On the Bank Nifty, that really is the weakest link of the market. And almost on a daily basis, HDFC Bank is closing at day's low. It starts higher but ends at the day's low. That's been happening far too often, and that's become now the go-to trade in the market to sell Bank Nifty on reversal of every rally.
All right, Anuj, thanks very much for that. So, large cut in PSUs, and I think that will be top of mind as we begin another session. We'll take a quick commercial break here. Suresh Ganapathy of Macquarie will join in with his latest call on 197 Communications, PTM. That's coming up in just a bit. Okay, welcome back. You're with us here on Bazaar Morning Call. We have Suresh Ganapathy joining in. Suresh, of course, he looks at banking at Macquarie Securities, and he's downgraded his rating on Paytm and cut the price target in a very steep way. Suresh, great to have you with us here, and so glad that you could join us. I know you're in the US, so it's late for you. Just a quick, a word. The market here, at least a section of the market has been betting on the fact that, the Paytm Payments Bank perhaps is you write that off, but the organization will tie up with other banks, change the QR codes or whatever it merchants. It's a big logistical exercise, but it'll get it done, and then continue the business. That's been the bet that some have been making. So explain to us, how are you thinking about this issue?
Sure. So Prashant, I think as we have always been saying, that the main business which makes them money is obviously the lending business, right? So they act as like a digital service, loan service originator, or a DSA for that matter. And now, in the absence of the fact that you may not necessarily have the same amount of data, customer loyalty, two-way customer flows in terms of customer versus merchants and vendors, not sure how strong would be their ability to retain the customers in the overall ecosystem. And I'm talking about customers, talking both the retail consumers as well as the merchants. So their ability to monetize the data comes into serious question, right? And clearly the view we have taken, and we have spoken to a lot of lenders here. So obviously we can't be taking any names here, but the feedback that we have got is that they are curtailing business. One lender, which is of course there in the public domain, and which is there in the latest analyst conference calls, is also Aditya Birla Capital having cut down their exposure significantly to Paytm. So my point here is that if at all the lenders decide to go back on cutting down their exposures to Paytm, then clearly the business model is in question, because that's the biggest profitable business for them.
Okay. No, Suresh, are the banks saying that they will not, allow this kind of a relationship with Paytm unless they get RBI clearance? I thought I heard Amitabh Chaudhary say that they will specifically ask for clearance. You think that will be a roadblock?
See, first to begin with, any customer onboarding of Paytm, the complete due diligence have to be done by the bank. It's very clear. Anyways, they were doing it for the lending side. Now, even for the other businesses like Paytm's payments business or wallets or whatever you're talking about, any business that they get, even the nodal accounts for that matter, every account needs to be completely, the KYC has to be done by the partnering lending or the banking institution, right? So that makes the entire process very cumbersome because you're going to do account by account reconciliation and then do a KYC. So clearly that process itself is going to be a tedious process. And in the meanwhile, the customers will exit, right? Those who want to know, anecdotal evidence has already revealed that a lot of these customers have moved on to their platforms, especially the merchants have moved on to the respective banking platforms. So that indeed the attrition happens and there is no incentive for the customer to be in the ecosystem, then it becomes a problem. Now for lending particularly, Lata, technically doesn't require any RBI approval, and as per the Reserve Bank of India rules, as a lender through the digital DSA model, the KYC has to be done by the lender, that is by the regulated entity. So anyways, the banks were doing. But what happens after an episode like this is that they are relooking at the relationships, right? And you also have to understand at the end of the day, if the data that is going to be sourced is not going to help the banks will have to relook at their relationships, right? So that's where the challenge is. If you go to their app, Lata, you will see that some of the bank or lender apps are not working. I mean, it's not necessarily you can access it, right? So clearly there is some embargo for the time being. Yeah.
They have a lot of money, free cash flow, the company itself. So do you think they can put that to work, improve their technology, their systems, and perhaps bounce back after a couple of quarters?
A couple of quarters is a bit too early, Lata. I mean, it's not that. I mean, we have a fair value for the entity at 275, right? So we see some value for the time being. Obviously, a lot will depend upon their ability to continue the relationships with existing lending partners. That's very critical. They also have cash on balance sheet, Lata, to the extent of about 8,900 crores. That itself gives you a value per share at 166 bucks, right? So, I mean, there will be a cash burn now in this entire process, right? So we have assumed a 50% discount to that cash and then arrived at a value. But in the current circumstances, our numbers take into account a significant 50% decline in the lending business revenues. If at all they are able to curtail and arrest that decline, then the valuation changes. As I said, again, the situation is evolving. For the time being, this is where we are seeing the current outlook is based on the channel checks that we have actually done with a lot of the lending partners and what they are trying to do at this point in time. I mean, if there wasn't an issue, then why would a lending partner cut the credit exposure or reduce?
So forget lending.
Suresh, just one thing, Suresh. You were saying getting a bank, right? If they get what I started with, you think that is not going to be a sign of confidence? I mean, on the payment side, I mean, you get a large bank to come on board instead of the Paytm's own payment bank. It won't give you. It's not a signal that maybe on the lending side as well.
Prashant, how will that happen? They have 1 crore accounts. Can 1 crore due diligence be done by a bank and then take 1 crore accounts in a single day or over 2 weeks?
Not a single day.
Let's be practical. The deadline is February 29th. You think in 2 weeks they can transition 1 crore nodal accounts to another bank? I don't know. I find this quite challenging. Yeah. So
right. No, it's not about that. I mean, the point is that they can. You don't think it can be done at all? I mean, I don't know.
It can be done.
Yeah.
Prashant, let's keep it clear. It can be done. Then who owns the customer then? If everything is going to go to a bank and if the customer is not there in the Paytm ecosystem doing a wallet transaction, fast track transaction, the merchant nodal accounts which were earlier there with the Paytm Payments Bank is no longer there and is moving to another bank, what could be the extent to which Paytm can retain the customers on the platform and use that to cross-sell? That's the question mark, right? So let's put it this way, that nobody in the system suffers. And from a consumer or a merchant standpoint, merchant to दूसरे किसी bank के पास जाएगा ही ना, and same is the case with the customer also. He will go. He's not going to lose money, nor the merchant is going to lose money. The point here is what will happen to Paytm and for its ability to retain customers in its overall ecosystem.
Okay, Suresh, we have a couple of more questions in terms of this customer retention. We have to take a mandatory break. Coming back in a jiffy with those questions. Welcome back. We've been speaking with Suresh Ganpati, the banking analyst at Macquarie Capital, who has just downgraded Paytm, and the target price has been cut very sharply to 275 rupees. Suresh, I wanted to know whether customer retention will be a rather insurmountable problem for them. Now, for instance, a lot of people are, their FASTag is on Paytm. They're linked for a whole host of bill payments, even insurance and such other regular payments through a Paytm. Will all these have to be severed, or can they be moved just to the app? Is there any way they can retain those customers?
No, so look, FASTag can't be done. You have to move to an HDFC or an Axis Bank or some other FASTag. Wallet business, which you used to do. If I was going in an Uber and using my wallet to pay the Uber driver, now I cannot do because the PPI license, in a way, it's not revoked as such technically. Obviously, they still have that license, but there are a lot of severe restrictions with respect to what can be done. You can only take out money from the wallets. So clearly, if your ability to do a lot of transactions on the Paytm platform reduces, there is bound to be consumer or customer attrition, right? So that's the question mark here, right? How much they are able to retain both on the consumer as well as on the merchant front going forward. The fact that a lot of the services which they could do on their own platform using the Paytm Payments Bank, now they will have to depend on somebody else in the system to manage it. And of course, you also have to understand that the terms and conditions when you're working with a third-party provider like a bank is going to be different than, to be honest, working with your own 49% entity, which is Paytm Payments Bank, right? So those are some of the challenges that Paytm has to contend with.
And the customers whom they are not able to transit to another bank, as you say, 1 crore looks really insurmountable in the next, couple of weeks or 2.5 weeks. In that case, they just lose those customers, right?
Yeah, to a great extent, yes.
Okay. And is it possible that
happening
Paytm voice
that,
box is very successful with merchants? I mean, the fact that a voice is telling you that the payment is made, you think that product is good enough for them to bounce back?
No, so look, we have to give credit to them that they have been pioneers in terms of certain aspects in the technology front. So there is a value associated with the kind of technology, network, and ecosystem that they have built over a period of time, and I'll not take away any credit from that. Now, the thing here is the competitors will also jump into the bandwagon. We have also seen PhonePe being a bit more aggressive, and anecdotal evidences are actually very clearly revealing that a lot of customer merchant migration particularly has already happened. To the PhonePes and to the other banks of the world. And our channel checks, when we have spoken to the bank managements, very clearly indicate that some of them have seen, 80,000-90,000 of new merchant enrollments easily happening within the last 1 week itself.
Fair point.
Right. So these guys have left Paytm and went ahead and joined with somebody else. Right. So you've seen that customer migration happening. Right.
Well, one final question. You've also written in your US notes about HDFC Bank. No attraction at all. No one willing to buy at distressed valuations?
No, there are definitely value guys which are emerging because when we would have ever thought about the fact that HDFC Bank becomes a value stock, right? And you have seen valuations now below 2 times price to book, almost 2 standard deviation below historic averages. So clearly the value guys who have a longer term horizon and are not looking at the next couple of quarters to really see any kind of a performance, they are willing to take a 3-year view and get into the stock. So to that extent, there is some interest. But we have definitely seen Lata long-only guys cutting down their positions. So if suppose somebody has 5% in HDFC Bank, they would have brought down by 200 basis points or 300 basis points in their EM portfolio clearly, or whatever is their global fund portfolio. So there has been definitely a cut in their positions with respect to HDFC Bank. And the problem here is, or the unanimous view by most of these guys who have been a bit underweight here, is the stock is dead money for the next 6 to 9 months. And therefore, why be, when we clearly know that we're not going to get any returns for the next 6 to 9 months, and perhaps move towards either other banks, or for that matter, move towards some of the other sectors, like say IT or Reliance or any of the other companies, right? Yeah.
Sure. All right, Suresh, we'll let you go on that note. Thank you so much for joining us and talking to us about Paytm and your report. By the way, for the market, the pre-opening rates have settled slightly in the green, up almost about 60 odd points. Paytm is definitely under pressure, down about 5.5%, but don't lose sight of some of the other PSU names. NBCC, Hudco, SJVN, all under pressure right now. And Hindalco is also down about 5%. So lots of big accidents perhaps today. But Sudarshan Sukhani and Kush Bora are with us to tell us how to approach the markets now. Gentlemen, morning to both of you. Sudarshan, it's been a volatile last few days for the market. What do you do today after the sell-off that we saw yesterday, and what are the individual stocks you're looking at?
Yeah, good morning. Yesterday was a surprise. I did think that the markets would Nifty would find support around 21,600 and see a bounce back. But that clearly did not happen. It was a steady downtrend throughout the day. Now, the problem is that the trend is still up. We haven't broken significant support levels. We are just chopping around and creating uncertainty. Within this uncertainty, the trade still for the Nifty is to look to buy once the market stabilizes. Keep a stop under 21,600. Below that, uncertainty completely comes in. So with that stop loss, after the period of stability, look to buy the Nifty. Intraday trade, this is an intraday trade. The bank Nifty is a complete avoid. It's now in some kind of a downtrend, and at least whatever it is, it's not in an uptrend. So avoid the bank Nifty, just focus on the Nifty with the levels I've talked about. Now about the stocks. Z is an intraday short. Z has seen a small rally, and that rally fizzled out yesterday. Sell with a stop above 192. Balrampur Chini is another stock that had a sideways range for almost 3.5 months and broke down yesterday. It's not good news. Short with a stop above 380. TCS is a buying opportunity. Buy with a stop above 4,060. Again, we are now going to defensives. And Asian Paints, where perhaps the downtrend is coming to an end, is a buy with a stop above below 2,915.
All right. Gentlemen, good morning. Sudarshan, thanks for that. Thanks for those trades as well. Kush, what about you? How are you set up this morning?
Hi, Prashant. So we spoke about the buy on dip strategy closer to the range of 21,600, 22,100. So we are there. We are closer to the 21,600 mark. We could see some sort of a rebound here, but what's happened for sure in the markets now is that the resistance has shifted from 22,000 to 21,800 kind of levels. So we could see some kind of selling pressure, not completely out of the woods yet. Also, the expiry, the weekly expiry pressures, start to play up today with the Fin Nifty expiry and then the Bank Nifty and Nifty. What the data is indicating is that there is heavy call writing at the ATM levels and near OTM levels. So the upsides could be limited. So, the markets may not go up in a hurry. So for me, the range has shifted lower for now. 21,500 and 21,800 are the levels that we're looking at. And, maybe you could just play the day's trend on the market. That's how I would, approach it, at least on the Nifty. Bank Nifty, as Sudarshan said, it's right now a very clear avoid. And if the third time around, the Bank Nifty does break its 200-day moving average, then we're looking at 44,400 and 43,600 zone, where, the index spent a lot of time consolidating last year. So Bank Nifty is an avoid. Nifty is still play the range kind of a move. As far as the stocks go, two picks, incidentally from the sectors that have done well yesterday, IT and pharma. So HCL Tech is seeing traction. A buy on that. 1695 and 1725 are the levels that we're looking on the upside. 1640 is a nice support zone. Granules is the second stock. 435, 450 are the levels that we're looking at on the upside. And 410 is where I would place my stop loss on the long side.
All right. Well, thanks a lot for that. Those are some stock ideas. MCX is facing some technical issues and trading will resume around 10 a.m. is what they say. So just keep an eye out on that. But remember, there was a steep sell-off in the PSU space yesterday. There was delivery-based selling as well. Sudarshan is joining in to give us a quick update on all that took place there. Sudarshan, over to you.
Yes, in a broad-based selling on Monday, both Nifty, PSE and CPSE indices fell 4% each, and PSU companies together have erased market cap of more than rupees 3.5 lakh crore. Remember, these PSU companies had hit record high just a few sessions ago, and from there, all these stocks are down somewhere in the range of 10 to 40%. On Monday, we saw huge delivery selling with delivery percentage to total traded quantity being as high as 50%. And some of these stocks with major delivery selling are NHPC with rupees 739 crore, IRFC rupees 500 crore, SJVN rupees 400 crore, and SAIL rupees 300 crore.
All right. Thanks a lot for that. Well, MSCI has announced its February quarterly review as well. Vivek is here with a list of additions, deletions and details of the rejig. Vivek, over to you.
Well, absolutely. Also, yesterday we had given you a heads up about, which are the stocks to keep on the radar that were likely entrants into the MSCI Global Standard Index. Remember, the index that we are tracking is the MSCI Global Standard Index, which is where most of the maximum impact will be felt in terms of either the inclusions or the exclusions. So this time around, largely along expected lines, there have been 5 additions made to the MSCI Global Standard Index. Remember, all of the changes will come into effect from March 1st, so the actual inflow and outflow will happen on trading day of February 29. So which are the stocks to keep on the radar? NMDC stocks will see inflows of over $160 million. GMR Airports, a slightly surprising entrant over here, $145 million inflow. Union Bank, $149 million. BHEL, $161 million. PNB, $184 million, largely dominated by PSU stocks. This was expected given the kind of outperformance that these stocks see. Apart from that, there are also quite a lot of changes, almost 27 additions and 6 deletions from the small cap index. With this, India's weightage as far as the MSCI index also has gone up quite significantly.
Okay, thanks a lot for that. By the way, a couple of more stocks, right? Coal India is up about 2.5%. We were telling you about the good numbers there. So there's some traction that you're seeing on that stock in pre-opening. And Zomato has been hitting new highs day after day. Today as well, Zomato is up about 0.3%. Easy Trip has also been moving up with quite a bit of strength. So some of these stocks are bucking the trend. But let's talk about Bharat Forge, because yesterday that was the big loser in trade. Plenty of brokerages are underweight or cautious on the stock after the kind of results that the company announced. Citi has a sell with a target price cut to 800 rupees. CLSA has a sell with a target price of 977, and Jefferies has an underperform with a target price of 950. Now, the company's commentary was very weak. They told CNBC-TV18 yesterday that Europe is seeing cost increases because of geopolitical events in its vicinity, and many export markets are seeing moderation as well as slowdown in growth. There was large delivery selling that we saw yesterday as well, to the tune of around 240 odd crores, which is 5 times the 1-month average. In fact, the F&O turnover was also quite high, and there were fresh shorts that were seen. So let's see which way the stock moves today. Yesterday, we in fact spoke with the company's joint managing director, Amit Kalyani, and he was very cautious on the industry as well as on the business outlook. Here are excerpts from that conversation.
Europe is under other pressure, right from cost increases due to both the geopolitical events in their vicinity and lots of fundamental changes in the overall European marketplace. So many sectors are seeing moderation in growth, even slowdowns. But we expect that we will continue growing as a company, except that this year we are growing 20%. I don't think that is always sustainable. We will continue to grow because we have many growth drivers of our business. Even if these main sectors do not fire as much, based on the market share gains and the new sectors such as industrial, aerospace and defense, we will grow and grow profitably. The US will be positive because it's going to be driven by the infrastructure growth. Elections are going to happen around that time, so there will be some push for growth. Plus, there is the whole emission norm pre-buy that's going to happen. But I think Europe will be slightly down. And overall, I think it will be flattish. But because of the market share gains, I think we should be having a positive growth. But there are many other sectors where we don't see the same thing happening. Sectors that were largely driven by China or where China was a big growth driver are going to see pressure.
Well, let's focus on the biggest loser today from the Nifty. Hindalco, it's under pressure. Novelis came out with its set of numbers. The adjusted EBITDA, no worries on that front. The adjusted EBITDA per ton closer to around $500 per ton. No worries out there. The guidance going ahead is good. In quarter 4, they're talking about the EBITDA per ton go to $525. Then they say post that it goes to $600 per ton. So no worries. The problem is the net debt has gone up marginally because of the big capex plan that they have. And here's the shocker. They went ahead and they increased their guidance for a 600,000 capacity that they're setting up in the United States. Earlier, they were talking about $2.5 billion. Now they're talking about $4.1 billion. That's something that the street doesn't like. They're also saying commissioning of this unit will be delayed by a little bit. So that's the problem pocket. The return ratios will get diluted. The capex heavy will eat most of the cash flows that come out there, and explains why the stock is down close to around 7%. In the past, I've seen this numerous times. Any big capex coming out of Hindalco, the street doesn't like, and they don't spare the stock as well. So that's why it's down 7.5%.
All right, Nigel, we'll keep an eye out on that one. Just, I think, counting down to the market open, that is. The pre-open has left us in a pretty good shape. 50 points higher on the Nifty, 200 plus points on the sensex is what we have. And, instead of the Nifty and the sensex, which we will put out, the Bank Nifty, etc., I think we'll start with what's happening on the CPSE and the PSU space, because that's the space which saw the maximum pain. The first rates are up on your screen. We've got the Nifty opening at about 21,650, the Sensex opening at about 71,250, which is 180 points higher on the Sensex coming through right now. And the Nifty Bank is coming up with about a 70-point higher start. So these are tentative first rates coming through this morning. Maybe we could just look at this PSU index, the CPSE index, and that'll give you an overall picture of what the rates are looking like. There you go. It's starting 10 points higher, neither here nor there. 0.25% now, 54.65. Sonia has crossed on the big wall with more rates. Sonia.
All right, thanks a lot for that. So let me just begin first with the stocks that are reacting to their numbers, right? You have Coal India, which is top of mind. Strong earnings. It was a top line beat, and the market likes that, up almost about 2%. The volumes are also picking up on Coal India. Novelis had good numbers, so let's just pull up Hindalco. But the problem, as Nigel was also telling us, is that debt has moved up quite a bit, and that's something that the street definitely doesn't like. So look at that, Hindalco down almost about 10% as we speak, the biggest loser at this point in time. Talking about big losers, that big downgrade that has come in from Macquarie on Paytm, the street is not like that. 7.5% lower on Paytm this morning. A lot of PSUs are in focus. NHPC, SAIL, etc. saw large delivery selling yesterday. There is some follow-on selling this morning as well. SAIL is down about 4.5%, even on the back of its earnings, so keep an eye out on that. Bharat Forge, after the 14% knockdown yesterday, Bharat Forge is seeing an additional 2.5% lower this morning. That's also because of the weak commentary from the management, and a lot of brokerages are negative on Bharat Forge. As we mentioned a while back, most brokerages have their target prices below the 1,000 rupee mark. Apart from that, we also spoke about SAIL, right, and the selling pressure over there. Let's move on to some numbers in the broader markets. Time Technoplast had a good set of numbers. The earnings were strong. The profits were up 50%. On the weaker side, you had All Cargo Logistics, where the numbers have been weak. GSK Pharma, the numbers have been weak. Galaxy Surfactants as well. The EBITDA is down about 27%. So these are a couple of spaces that are not looking good. All Cargo Logistics now down almost about 5%. And in a bit, we'll get GSK Pharma. Look at the damage there. Almost 8% gone on GSK Pharma as we speak. And so, the market is definitely in a mood to punish any hint of bad news, whether it's weak earnings or it's downgrades that are coming in from brokerages. Paytm now down almost about 6%. Otherwise, it's a very, very flat opening. You can't really say that it's good or bad, just waiting for the market to settle, but plenty of stocks in focus. Nigel, back to you.
Well, I'm looking forward to my chat with the Hindalco management in the next few hours or so, because the stock is down. We'll require clarification of why such a big uptick in terms of capex. And the street doesn't spare it at all. It's down close to 10% as we speak. Big selling out there. IRB Infra is another stock that's down close to 4%. So some money being taken off the table on some of these stocks that went up one way. SAIL, I told you all earlier today, the adjusted numbers looked quite weak. They're sitting on inventory, and the debt number goes up as well. In the past 10 years or so that I'm tracking the company, every time it goes to 150, you're hoping that now this is its time. Apna time aaya. It's always something or the other comes about. And the stock, yet again, went to 150 rupees. It's back down at around 3.5% lower in today's trading session. But I'll wait for some more clarity, with regard to that real price revision that they're talking about, inventory in the books, and has debt peaked out. For the time being, the stock is reeling under pressure as we speak. Hoodco down 2.5%. Nalco, ahead of its numbers, is down close to around 2%. On the flip side, there are a few stocks that are doing well. Gujarat Pipavav, I think they came out with a set of numbers which looked pretty okay. The stock is up close to 5.5%. JM Financial is up close to around 5%. And IRFC as well. Some of these railway themes are coming back. RVNL as well is up close to around 3% or thereabouts. And as we did that market check, the markets that were up, the Nifty that was up 50 points, has come down to around 5 points.
Nigel, Paytm has recovered about 4% from the day's low. So the low was about 386, and it's come up to about 400 plus now. 407 is where we are. So there is at lower levels buying which is emerging, most definitely. And I think that's interesting to see. So 2 million plus shares on Paytm already coming through. But, this is the first 2 or 3 minutes of trade that we're looking at. Just a few more names before we go any further. Market breadth is negative, but, it's vastly different than yesterday. Yesterday was just completely one-sided. Today it's not. So Hindalco, I think, as you mentioned, 10% lower. It's the number one volume traded loser right now. SAIL is at number 2 with a 5% cut. JSL, Jindal Stainless, I think, is down 9%, 536 there. Parag Milk, which had a very sharp move, is at number 4 with largest volume-led loss, 5%, 4.5, 4.75 lower. There is Sterling Wilson, which is down 5%, 555. We mentioned Glaxo, Sonia mentioned Glaxo, 6.5 lower. HEG, Nigel was talking about that, the numbers, etc., 4% lower. There is IRDA, which is down 5%. EMS Limited is down about 5%. Stocks at about 527. All Cargo is down 5%. Again, we highlighted the numbers earlier with Upasana. LG Equipment is down 6%. There is Jyoti CNC, which is down 5%. And then volumes kind of thin out. I think market breadth now almost evened out 1:1 in the broader market, and that's the number to kind of watch out as well. Some of the top gainers, some of the top volume-led gainers are PSUs. NHPC is back up 5%. It'll come up. IRFC is down 7.5% at 152. RVNL is up 5.5%. IRCON is up 6%. So this is, Central Bank is up 3%. Cochin Shipyard is up 3.75%, all with large volumes. Bank of India is up about 3%. GMDC is up 5%. NLC India is up 6%. So the Shipping Corporation is up about 2.6%. So the PSUs, which saw a violent shake-off, there is no real big follow-through. At least that's the first couple of minutes of what we are seeing in terms of price action. Many are up, some are down, but that's largely on the back of some specific earnings disappointments, etc., which we will get to in more detail as we go along. The Nifty is up about 20 points or so. It's not a dramatic open. It's like any other decent start that we have. Manish Gurwani is with us. He's head of equities at Bandhan AMC. Manish, great to have you with us here. Thank you very much for your time. Just a quick word on what we saw yesterday with the sharp sell-off across PSUs. It's kind of interesting because this sharp up move has happened at a time when big sectors like banking and some of the largest stocks within the banking space, which were considered high quality and still is considered high quality, HDFC Bank, they've been languishing. So there's been such a sharp divergence, and I think that's prompted many to say that now is the time to actually focus in a big way on large caps and reduce exposures across mid and small caps. Just wanted your thoughts there, Manish, to begin with.
Actually, I'm not very focused on large versus mid. I think in a world where globally, I think growth will be soft and where liquidity will be easy, I think we should not cut the market on the dimension of market cap. I think you have to do bottom-up work. It's a very self-help market to my mind, because what will happen is when both global growth and India growth is also range-bound, like we are seeing with metals or IT services or with banking, there is no industry acceleration that I think you can expect. So, for example, do we expect bank credit growth to go from 15% to 20%? Do we expect global IT services growth to accelerate? I don't think we should. I don't think we can forecast that acceleration. In which case, it's all about, trying to get a stock at a good risk reward, and I think medium-term liquidity will be fine. So I'm not so fixated on. Of course, we will see these tactical corrections if the small cap index has been up 50%. You should expect at some point these tactical corrections to happen.
Thank you so much.
But I think the money will be made by having a 2, 3, 5-year view and just focusing bottom up on themes or stocks which can deliver earning surprises.
That's an interesting way to look at it. I guess that's the best way to look at it, right? Just pick your stocks, pick your sectors. It's always great to see you, on the show, Manish. I wanted to start by asking you about what sectors you can buy for the very longer term, right? Where do you see both value as well as growth potential now?
Yeah, Sonia, actually, I don't think buy and hold investing works anymore. And so I'll not go into the long-term aspect. But yeah, there are, I think, good multi-year cycles that are playing out. I think we've talked about the energy transition and power capex. I think that looks like a good 4-5-year theme. I think there is a risk reward in betting that at some point rural or mass consumption may come back. I think US pharma, generic pharma looks interesting. Real estate, I think, is a sector where we are seeing not only good demand, but supply side consolidation as well. So I think these are some of the themes worth looking at. Now, within that also, obviously, there are stocks you may like, you may not like. But yeah, I think these themes to us look quite interesting.
That's an interesting thing that you said. Buy and hold doesn't work anymore, Manish. So let me pick on that a little bit. just explain that. Yeah. Are you saying that business cycles have become much shorter? Something else has changed? Yeah.
So 2-3 points. One is that business cycles are shorter. Two is the price discovery of that cycle is faster, right? So what I'm trying to say is that if you find a stock which can compound earnings over next 10 years, let's say, maybe 15 years back, every year you would have got 20-25% kind of return. But the price discovery is so efficient today that in the first 2 years you'll make all the money, and then you have to go and find another stock which is like that and which is undervalued, right? And the third point is that the overall global growth, given the demographics and debt, is such that I don't think there is very high macro growth you can expect anywhere in the world, actually. So the landscape for, let's say you assume that if banking credit can grow at 15-20% for next 5 years in India, then you can bet on a small bank becoming big. The thing is, no one has visibility on that 5-10 year basis anymore. So because of these reasons, I think you have to be very nimble. The amount of institutional money is going up, which means that, as I said, not only are business cycles shorter, but the price discovery of that cycle is also faster. So I think you need to be a bit more nimble than you were 10-15 years back.
Okay. I wanted your thoughts also on spaces like autos, for example, right? They've come back in a big way. This whole electrification theme is playing out. Tata Motors, for example, has doubled in the last 1 year. Do you see this as a structural growth story, or do you think we've reached a mature phase of the upcycle?
So in general, we like autos as a house. We're broadly overweight, more on the passenger and the two-wheeler side, not so much on the CV side. But yes, I think global auto also, last 3-4 years post-pandemic, the recoveries in Europe, China, etc. have been weak. So you can expect that at least we're not buying something at top of the cycle. So yeah, I think autos in general is an interesting space at this point of time.
IT. So just to, it's not large cap versus mid caps. It's not buy and hold. But what about global versus domestic? Because domestic oriented sectors have done extremely well. Manufacturing, industrials, capital goods, right? Maybe banking, not so much recently. Private banks, that is. But what about export sectors? I mean, do you see opportunities there? Tactically or maybe slightly longer term?
In general, I'd be more bullish in the domestic sector still, although the valuations have gone up. There might be some tactical opportunities in sectors like IT and metals. But really, when Europe, Japan, China seem structurally weak, US also entering a cyclical slowdown, that's the broad consensus, although it's not happening. I don't think you can be very bullish on large exporters because, again, the large exporters are typically mature in terms of market share. So it's not an emerging theme in one sense, right? There are obviously emerging export stories in capital goods, pharma, etc., which seem more interesting than the very large sectors. And I think the medium-term challenge for exporters could be, and we need to see how it plays, but I think that can very well happen, is that the rupee can stay flat for probably the longest period of time we've seen. And then the margins of exporters are obviously can come under a lot of pressure, because I don't think we've seen rupee being flat for 3-4 years. It's already 1.5 years, and the way the macro is shaping up, we may have, unless something unknown happens, given that our current account seems very, very solid. The dollar has done well for last 10 years. not likely to appreciate at a global level. In which case, let's say in 2-3 years, rupees 83, a lot of the exporters are, their business model is predicated on consistent rupee depreciation. So I think that can be a challenge. We need to see that part how it plays.
Okay, all right. Well, just, wanted to mention one thing on the markets. It's flat now for the headline index, but there is a steep sell-off that we're seeing in the mid-caps. Just look at that. 400 points gone in the mid-cap index, and lots of stocks are now moving to 10% cuts. NBCC is down about 8%, IRB Infra is down 7%, Hudco, SJVN. Manish, I wanted your thoughts here. Suddenly from being, the most loved sector, the PSU space has suddenly become, untouchables in the last couple of days. What do you do here if you own some of these PSU names?
Again, Sonia, I don't think it's fair to just buy a stock because it's PSU or not. There are pockets which look interesting to us, which is around the power space, and there are pockets like defense which look expensive to us. So I think everyone needs to do their bottom-up research. As I said, in general, we think the power space is interesting and the PSUs within that look interesting. You can take some bets on the divestment theme, I think, because clearly if the election outcome is favorable for the market, there is some basis to say that a lot of the divestment, the strategic divestment which didn't happen in the last term, can come back. So those are the bets you'll have to take. But I, for example, find defense to be very expensive. So I think it all depends which pocket of PSUs you want to be.
Manish, we'll leave it there for today. Thank you very much. It's a great conversation as always, and appreciate your time here on CNBC-TV18. We have the management of PI Industries waiting by, but I'll just take 30 seconds because it's important and markets being the focal point. The Nifty is down 60 points. And if you can just quickly show me a few of these large movers, because it's flipped. Market breadth was 1:1 about 5 or 7 minutes after market open. It's now 4:1 in favor of declines. So it's completely flipped. More, actually. So almost about 6:1 now. Very sharp kind of deterioration is what we've seen. And look at these. SJVN suddenly becoming the top volume-led loser, 7% lower. NBCC is down about 8.5%. Hudco is down 8%. There is Indiabulls Real Estate, which is down 6%. Parag Milk is down 8%. It started down 4%. IRB is down 8%. There is HBL Power, which sold off 10% yesterday. It's down another 8%. It's been one of the big, it's basically tripled in the last 2.5 years. HEG is down 7%. Phoenix Limited is down 4%. Glaxo, etc. We mentioned. Bajaj Hindustan is down 6%. There's KPI Green, which is down 5%. JBM Auto is down 8%. Gensol, which has been such a big winner, is back to just under 1100, is down about 5%. So a dramatic turn of events, but just still the first couple of, it's been 15-20 minutes or so as far as market open is concerned. Not even that. 70 lower now on the Nifty. But as I said, we have managements waiting by. PI Industries is the first. Sonia.
Absolutely. And, it's going to be interesting to hear out the management because they reported a strong set of numbers in Q3. The gross margins have improved. Agri-chemical exports have surged in double digits, although domestic revenues have been subdued. Mayank Singhal, who's the Vice Chairman and Managing Director at PI Industries, joins us now to talk about that. Mayank, thanks a lot for joining in. I want to first talk about the export market, which has been picking up quite a bit. Can you explain the reason behind that and what kind of growth are you expecting to see in exports in FY25?
Yes, good morning. Thanks for having me today. We have seen the growth in the export market, as you know, from the innovative business model of PI, where we focus on the new generation innovative products. As you will see, this sector continues to grow for innovative products. While you will see certain downturns, you've seen the ag sector, which is purely driven by the generic business, which has been on the downturn. But PI being in a niche and the innovative spaces continue to grow, and we continue to see the projected growth that we have stated earlier.
No, I want some numbers if you can share with us, please. What kind of growth are you targeting for exports particularly? And have any of your markets been hit because of the Red Sea crisis and the uptick that we're seeing in freight rates?
Well, as we've indicated, about 18 to 20% growth, and we continue to be on that path there. Yes, the Red Sea has its impacts. Obviously, it is having logistics challenges in terms of times and delays, but I think those have been all aligned, and we are working well with the customers to meet our objectives.
Okay, hi. Good morning, Mr. Singhal. Nigel on this side. You're working with your customers, so do you mean that they are the cost increases they are absorbing?
Yes, there are going to be marginal freight cost increases, which we will be working with our customers to take them up. Yeah. As you would see, freight is not a big component of our total cost structure.
Got it. So no big worries on that front. That 18 to 20% that you're talking about, will you likely hit the upper end or is it going to be the lower end?
Well, I would still stick to my 18 to 20% as indicated.
Okay. All right. I wanted to focus on diversification. You've made some steps, with regard to the acquisition, and the pharma segment could see some kind of growth in the time to come. My question to you is, in FY25, what kind of a number can we get in terms of revenues from the pharma business? I think for this year, you'll end somewhere in the vicinity of around 500 crores. So for next year, what can it do? And what kind of profitability can you guide for as well, just in this segment?
Well, I would say for now, we'll just, within this year, we're just probably three organizations we are integrating. We are building our strategy. I think we'll be in a better position to answer this at the end of next quarter. But we definitely see that sector to be interesting. And as PI way, we're going to build a unique strategy, which is going to take a little longer time to deliver the unique value that we're always able to create so far.
Okay, all right. I've just got a note. I'll just complete that point. For FY25, a couple of brokerages are estimating that you do somewhere in the vicinity of 625 to 650 crores from the pharma segment. Possible?
Well, I'll keep that for a guideline for now, yes.
All right. Mr. Singhal, hi. Good morning. Could you tell us what was the growth in sales from new products and how much did it contribute to revenues this quarter?
If you see the new product growth has been about 50-odd% as mentioned during the investor call. So that's been the contribution of growth from new products in this quarter.
Okay. And you think, that's the rate that we should expect, or it'll moderate as we go forward?
Well, this is not a quarter-to-quarter focus as you would appreciate, because these are cyclical in nature of the business. So obviously over the years, we have a good freshness index, and we continue to expand that front from our end, yeah?
Sure. Mr. Singhal, can you give us some more details on what's happening in the pharma business? Just trying to understand in terms of a timeline, when do you think you can become profit positive in the pharma business?
Well, as we said, we're right now in the process of building and integrating these organizations. So we're investing in both resources and capital to develop capabilities. And I would be in a better position to answer this at the end of next quarter.
Okay. Can you also tell us, you said 18 to 20% is what you're holding on to for the full year of FY24. Do you think, given the situation currently, both in exports and the domestic market, is that something that you can do a 20% growth even in FY25, or is it too soon to make that observation?
I think it's too soon to make assumptions right now. As I said, we are maturing our plans, but we are seeing not a bad trajectory as per our strategy for the coming year.
Okay. All right. So Singhal, has there been any price erosion in pyrosulfine due to competition coming in? Has there been any kind of hit to revenues, and do you expect some further price erosion out here?
Well, we are on the more, I'd say, the contract manufacturing side. So, and the product is sold by the innovator, and I would not be in a position to comment on that. But obviously, as genericization happens, price erosion happens, but manufacturing has a different impact, yeah.
Okay. All right.
Can you at least tell us if there are any more price cuts that you think that would be coming in pyrosulfate?
Well, that would not be the right moment for me to comment, as is the molecule of the innovator, and it's not a position that I would be taking a stand on, yeah.
Would there be any risk from this going off patent? Because this is going off patent to some degree in the next 2 years, right?
Yes, so as you would appreciate, we're in the manufacturing part of the value chain, and manufacturing has its costs and its deliveries, and obviously price erosion does happen, and that's more impacted to the marketing front side, which is held by the innovator.
Okay. No, but if on the innovator side, more players come in, as we've seen with other compounds in the past, prices can fall very sharply, right?
Well, not necessarily depends on compound to compound. On the other hand, if they do come down, then it also expands the markets. And we've also seen that when that happens, the markets have expanded 2x or 3x for these products. So that's where we are working and with our partners to build that strategy.
Okay, Mr. Singhal, final question before we let you go. You're sitting on a fair bit of cash. You have mentioned that you'll want to focus more on the non-agrochemicals molecule part of the business as well. You have done a small acquisition in the recent past. Are there more acquisitions in store? Is there more inorganic growth on your mind?
Yes, the company is looking at inorganic opportunities, which are synergistic and can offer unique technological capabilities for the organization to develop itself going forward for a sustainable growth.
So sometime in the first half of the next fiscal, should we hear something about this?
Well, unfortunately, you can't predict acquisitions like that. They take their own
What could
time
the size be? Give us a sneak peek, Mr. Singhal. What are you scouting for? What could the rough size be?
That's not to be let out right now for sure.
Okay. We'll just take it that you're on the prowl and you're looking at it, right?
Sure.
Okay, all right. We'll leave it at that. Thanks a lot for joining in and appreciate your time here on CNBC TV18. But let's do one thing. Let's move on to another set of numbers now. Samvardhan Motherson reported a good set of earnings for Q3. Revenue saw healthy growth. You had the margins that are strong. Net debt is also declining. Pankaj Mittal, the Chief Operating Officer at Samvardhan Motherson International, and Kunal Malani, the Chief Financial Officer at the company, join us now to talk about that. Gentlemen, morning to both of you. Mr. Mittal, I want to start with you. It was a very strong revenue growth of 27% that you saw in Q3, and 9 months of the year, a 27% growth as well. What do you think you can end the year with, and what is the growth forecast for FY25? You think you can do this 25 to 30% growth?
Well, Sonia, good morning, and thanks for bringing us to the studio today. As you know, we have a clear vision for 2025, and we continue to move towards that. So we all are working together with our customers. There are lots of opportunities which are there in the market, and we work together with them. So this growth has been both organic as well as inorganic, as we have already absorbed some of the mergers, the acquisitions which we had done. Few more acquisitions are in the pipeline, which needs to be merged into the company for $1 billion plus like Yachio and others, which we had announced earlier. So we do see a good growth coming forward while we absorb these acquisitions as well as organic growth in the emerging markets.
So you were telling us about the pending acquisitions, right? There's Yachio, there's Sirma Enterprises, there's the Lumen Group, ADI Group, etc. Can you tell us when all of this comes together, when it gets merged into the entity, what will the growth be that we're looking at for the consolidated entity in FY25?
It should be somewhere between $1.1 billion to $1.2 billion additional revenue coming from these.
Okay, $1.1 to $1.2 billion of additional revenues with a lot of these acquisitions, that is Yachio, Sirma, Lumen, etc. I think this contribution will come in from FY25 onwards, right? So we are looking at it in FY26?
This will come in like, in the next 2 quarters, they should get absorbed. So we do expect that that should happen. So as you know, the closing sometimes takes a little time, but we do see this coming in the next financial year.
In the next financial year itself. Okay, got it. Kunal, come in on the situation right now as far as the globe is concerned. 45% of your revenues currently comes from US, Germany and China. How is the global situation at the moment and what kind of growth do you see there?
Well, actually, there was a little bit of changed mix that we saw. If you would have seen our presentation, we spoke about the fact that somehow the mix on EVs actually went down. The mix on the premiumization also went down a little bit. But then when we dug deeper, we realized that a lot has got to do with the fact that some of the launches are yet to occur. And hence, as the launches come in, we should be able to see again the premiumization portion of the growth kicking. That's the one that actually matters from Motherson's perspective. At an aggregate level, I think we were pleasantly surprised by the resilience of the European market. The American market was impacted by the UAW strikes that occurred. Hence, our OEMs were impacted there. But right now, we see some degree of stabilization in that market as well. And Asia, especially India, continues to do well.
In your presentation, you said in your conference call actually that in Europe there may be some demand softening, especially for the businesses like PKC, right? And you do have a large presence in some of these European markets. When you talk about demand softening, what are you saying? Because, yesterday we had a word with the management of Bharat Forge, and they said that forget moderation and growth, some of the export markets are even seeing degrowth. Could even see degrowth in FY25. Is that something that you would concur with as well? And if yes, what would the impact be on your own business? How much could the degrowth be in Europe?
Well, actually, the degrowth that you're seeing is driven off the commercial vehicle side. I would say there's some degree of softening that we are seeing in Europe there. But on the passenger car, you would have seen in the presentation, it grew actually 17%, which pleasantly surprised everyone. The production levels continue to do reasonably well. Obviously, there is the overhang of all the interest rate cuts, etc., or interest rate rise, etc., that has been there. So there is a belief that there's some degree of softening that would occur, but we are still yet to see it, at least on the four-wheelers.
All right. So you're saying there's softening in the commercial vehicle side in Europe, but passenger vehicles continues to be strong. Mr. Mittal, since we're talking about Europe, right, the currency in Argentina is significantly devalued in the past few quarters on account of hyperinflation there. And there have been stringent exchange controls by regulators as well. I want to understand what could the impact of this be on your business over there?
Well, this is already factored in the results, as you would have seen in our release, that this hyperinflation has led to a situation which has impacted the business in the sense that we can't take out the money from Argentina and we have to continue supplies. So this has been taken on both sides. So the peso has changed to a dollar from 200 pesos in March to about 800 pesos so far. So this is under discussions with our customers, and while we take them into our accounts as of now, we do believe that we will be able to work it out together with our customers to find a good solution.
You have mentioned it in the press release, but you haven't mentioned an amount of what the impact would be. Can you give me that amount in the subsequent quarters, any hit that you're expecting to face on your margins, etc., because of this currency devaluation?
We can't predict as to what will be the amount in the subsequent quarters, but we do have given the amount which is there in this particular quarter. So I would, Kunal, would you like to add to this, please?
Impact has come because of the sharp depreciation of the Argentinian peso, which moved from about 200 a year back to 800 to a dollar now. And that is what has caused the revaluation of many of our assets as well as liabilities, more importantly, because we're not allowed to pay back these liabilities as per the strict control regulations there. And hence, much depends on how the currency really behaves. At the same time, these are all customer-nominated suppliers, and hence we work with the customers to find an amicable solution. We hope that sooner than later we are able to solve this along with the customer, like many other aspects in our business as well.
But I think this is, spooking the market a bit because the stock has also been under pressure, and Europe is a large chunk of your business, and now we are seeing such a sharp devaluation in the currency in many of those pockets like Argentina. Do you think it will be hard for you to get to double-digit margins? Because, even in the quarter gone by, your margins have improved, but it's still at about 9.5%. Do you think double-digit margins could be far out? And if yes, what are we looking at in terms of a timeline?
Sonia, I think we've discussed many number of times. We really don't focus on margins. We focus on ROCE. On the ROCE side, if you see, we have improved from 16 to 17 if we were to consider our vision plan, and to 15% if we were to consider our reported situation. So directionally, we seem to be improving. We have continuously maintained that we will be, on a year-on-year basis, be showing continuous improvement. The integration of many of our M&A should be able to support not only growth in those respective pieces, but synergies across other lines of the business, which should then add up to what you're saying as margins. So, and growth for us. So directionally, I think we should again be on an improvement path is the way we see it. We are referring to some degree of softness, but frankly, with the slew of M&As plus the slew of newer opportunities that we are seeing in the market, I think right now we are pretty much inundated with opportunities. So
Okay.
growth is not a challenge, and margin flow through.
Okay, all right. Just two quick questions from my end. Since you're talking about the slew of M&As, right? This Lumen acquisition that you've done, and a large part of their business is in the wiring harness space, which is growing quite a bit. Mr. Mittal, I want to understand from the Lumen acquisition, what could the contribution be to your own business? And the other part of my question is on the debt. Debt has gone down. Is there scope to decrease it further?
Well, Lumen acquisition will add, about 100 million plus of Aussie dollars of business. And it's a very interesting business because this brings us to support the Aussie market where the OEMs had stopped manufacturing, but it remains a big consumer and there are a lot of fitments which are being done. So this company works together with the OEMs to make those vehicles for the Aussie vehicles, to tweak them. And this is very interesting. And then they're moving into other markets as well. Coming to the debt reduction, yes, we have a clear direction that we would like to continue to work while we have invested more and more into the acquisitions. Also, you have seen that our leverage ratios have come down, and we work towards that to reduce the leverage ratio, to improve upon our working capital, as you would have seen from our presentation, that how we are improving on our working capital as well. So inventory reductions, optimization at all places. And the board really commended all the teams across the world for working in this direction and for the outstanding results in this quarter.
All right, we will leave it at that. Thank you so much, Mr. Mittal, as well as Kunal, for joining us and explaining the business as well as the way forward. That's Samvardhan Motherson. The stock is down about 3% because some of its businesses in Europe are facing a lot of pressure. There's a massive currency devaluation that you're seeing in Argentina. For example, in March of 2023, the Argentinian peso was 209 to the dollar. By December, it went to 800 to the dollar. And that devaluation has really hit some of these, companies that have businesses there. So I guess that's the reason the stock is also under pressure.
Valid point. Sonia explains why the street is a little bit nervous on that front as well. By the way, quick check on the markets. We're more or less flattish, but the railway stocks, they are really running along. You have IRFC that's moved up close to around 7%. It was trading in the red in the initial moments of trade. RVNL has moved to the high point of the day. It's a big spike up out there. And IRCON as well. So all of them, the train is moving quite well on that front. These stocks are seeing a big recovery. For the time being, slip into a short break. On the other side, we'll get chatting with Mr. Sharma of NCC. They reported their Q3 numbers. Stay with us. Welcome back. Well, let's focus on NCC. They've reviewed their revenue guidance upwards to around 32 to 33% for this year, for a year-on-year basis. Mr. Sharma, the head strategy at NCC, joins us on the show. Hi, Mr. Sharma. Good morning, and thanks so much for speaking to us here on CNBC-TV18. Well, a couple of quick questions before the code of conduct sets in. The order inflows will be something that the street will be focusing on. I think earlier you were guiding for around 26,000 crores. You're at around the 21,000 crores odd. Do you expect to stick to this guidance?
Sure. At the very outset, very good morning, Nigel. You are right that, the order inflow guidance that we had shared with the street, it was, 26,000 crore. And as we speak, we have already booked about 82% of that number. That is 21,238 crore to be, precise. And as we speak, we continue to, stick to the guidance that we have shared with the street. We are quite hopeful of hitting that number by end of this fiscal.
Okay, all right. So we've got that out of the way. Now, for FY24, you've gone ahead and upped your guidance, which is good news. Street will be very, very happy about that. But what it does sometimes is it adds a lot to the base, which makes the next year a little bit more challenging. So to call it mathematically. But with the kind of order book that you have, maybe in fact anything is possible. So could you tell us, for FY25, what kind of a revenue number are you targeting? You could give us a broad range, revenue growth as well as revenue.
I fully agree with you. Well, let me bear with me for a couple of minutes. The way we work in the infrastructure business is, whenever we talk about a future number, number in terms of revenue and margins, what we essentially do is we try to look at each of these projects individually, and we have about 150 odd projects. So we try to look at each of the projects and then try to assess in a realistic manner what is the execution that we can do for each of these projects, and then we work out that number and share with the street. We have not started that exercise, That is something that we would be completing. Then we would, seek the approval of the board. And I would be very happy to come to your show and, share that number in May, because we have to take the approval of the board before we, announce that number. So that is something that we typically do in May.
Right.
I hope that answers your question.
We're looking forward to having you on our show.
Mr. Sharma, hi, good morning. Just to pull
Good
back
morning,
just to pull back a little bit and look at the slightly bigger picture, if you look at FY25, the budget that we've just seen from the government, right? Two areas. Roads has seen allocation in FY25 by the central government, which is only 3% higher as compared to FY24. Last 3 years, roads were seeing between 50 and 25% growth in allocation. This year, it's 3%. The other segment is housing and infrastructure, which is also seen around a 3% higher allocation. So the absolute amounts are higher, but the rate of allocation has actually come off quite sharply. So and those are two segments which I think are important. Now, I understand this is central government budgets and state governments that will be still spending, and you'll have to look at that. But do you forecast any slowdown at all in FY25 if numbers are what they are?
Not really, As if to take, leaf from your playbook, we have already booked, good amount of orders in this financial year as well, For example, we are sitting at an order book of about 57,440 odd crores. So even if I were to accept the proposition that you are talking about, that there might be possibly some slowdown. So still we have, sufficient amount of orders are already available with us, and all that we need to do is to go out and execute. And this is what we have successfully done in the last, 3 quarters of this fiscal. So even if there is a slowdown, but I think the larger picture possibly is not the decrease in allocation. You are aware about, the elections are around the corner, and, that might slow down, the pace of the award for a couple of quarters.
Got it.
So, but we have nothing really to worry about. And typically in any financial year, the 80% of the execution comes from, mostly the existing projects, the newer projects. Let us say that if we bag a project in this order, the contribution in the next financial year will not be, very high from these so-called new projects. Most of the execution is done from the projects that we have already bagged. The drawings have already been approved. We have already mobilized,
Mr. Sharma?
So that is not something that really worries us.
Got it. That's about the order book. I wanted to understand a little more of what's happening with the balance sheet as well. By when do you expect to get the receivables from Sembcorp? How much have you received so far? What are we looking at in terms of the timeline?
Sure. So as we had, shared with you, in the last conversation that we had, in the award, we were to receive about 197 crore from them. And I'm happy to report that in this quarter, we have already received about 147 crore from them. So 50 crore is the remaining part of the money that we have to get from them. But we understand that, they have decided to challenge this part of the award. And that is something that we will have to wait and see how things really pan out.
Okay. And what would all of this mean for your debt levels? What is a net debt at currently? Do you have any scope to bring it down further in the next 1 to 2 years?
Sure. We have already shared a guidance in the call that we had a couple of days back, in which we have already shared a ballpark number of about, 1,300 to 1,500 crore by end of, this financial year.
Okay. All right, Mr. Sharma, could you tell us what are the potential orders and revenues you're expecting from the Jal Jeevan mission?
We already have a very healthy, order book from this Jal Jeevan mission project. As we speak, the total order book would be close to, a little less than 18,000 crore. And we continue to see healthy pipeline of projects in this space. And on case-to-case basis, we are bidding for all these projects, and we are quite hopeful of bagging at least a couple of them in the next financial year.
Okay, all right. We'll leave it at that, Mr. Sharma. Thanks a lot for joining in and speaking to us. That's NCC with their view. But let's talk about the technicals of the market now. It's really all over the place. The mid-cap index at one point was down about 1%. Now the mid-cap index has recovered. The entire market has recovered. In fact, the Bank Nifty is the one that's really batting for the bulls this morning, up almost about 400 odd points. And the sensex is up 275 odd points. Prakash Gaba is joining in now to give us his view. Prakash, it's really all over the place, and this volatility doesn't help anyone, right? I mean, you generally tend to sometimes burn your fingers both ways. What do you do for the rest of the day, and what are the individual stocks that you're looking at now?
Yeah, volatility for a trader, I think is very good, excellent, super. The more the volatility, the more the trade. If it's going up, buy and sell. If it's going down, sell and buy. And good morning to you, Sonia. Well, structurally, Bank Nifty looks good to me, better now. It's trading at somewhere closer to futures 45,474. We can see an up move from here. Only thing is we need to have a stop. I would have a stop on Bank Nifty at somewhere closer to 45,200 and trade long. Now, if it goes up, possibly we'll see maybe a move around 100, 150 points. So there is a move on Bank Nifty. I would avoid Nifty per se. Stocks that I like too. I think I like Axis Bank. Yes, looks good to me. Trading at 1,060 zones. It's given a breakout. Possibly we'll see a target with 1,070. I would have a stop below 1,055 on Axis Bank and trade long. Second stock that I like is again for the bank, and that is ICICI Bank. It's given a beautiful breakout. The move is good. Trading at 1,014. Would I have a stop at 1,010? Yes, 4 rupees stop loss. That's good enough. The upside, the target is around 1,025 to 1,030. There could be a good move available. The ratio also is in our favor.
All right. Those are individual trades and recommendations coming through. Prakash, thank you very much for that. We'll come back to you for more in a bit from now. That's the important news flash at the bottom of the screen. Trading at MCX should resume at 11 a.m. We put out earlier that they were hoping to start trading by 10 a.m. There was, something which they were tentatively hoping to do, but not anymore. And trading will only resume at 11 a.m. And the team is working to resolve some of the technical issues. Remember, I think over the last several weeks, we've sort of had issues. We've had sort of, reports of some issues at MCX in terms of the trading infrastructure, etc., settlement, and so on and so forth. So this is not new, but this is now new information coming through that trading will resume at 11 o'clock. Well, we'll take a quick commercial break here. We'll focus on some of the other stocks on the move in just a bit from now. Stay with us.
Well, the big accident this morning is coming on Hindalco. That stock is now down 10%. Nigel, what's the reason for that?
Well, Novelis came out with a set of numbers, and the numbers were bang in line. On the EBITDA per ton came in at around $500 per ton. They've also guided that in the next quarter, the EBITDA per ton moves to $525 per ton. And, in the subsequent months or quarters, it's going to move to around $600 per ton. They have all those plans in place. So no worries on that front. The problem is the debt moved up marginally. That as well is okay because they have a big capex underway. The biggest problem about these numbers were they shocked the street. They went ahead and they increased their capex on the 600,000 ton plant that they're setting up in the United States. Earlier, it was at around $2.5 billion odd. Now they've upped that to around $4.1 billion. And the street doesn't like this sort of a capex spike. In addition to that, they've also said that the project was expected to be completed in the early part of the first half of FY26. That's the financial year. Well, now, in fact, they're talking about in the second half of calendar year 26. So that's the problem with, with regard to higher capex as well as delay in the project. Brokerages, Equerris, they have an ad rating on the stock, target price of around 570 rupees, but they're saying the IRR on this project from around 17% earlier, now they're working with around 10 to around 12%. Jefferies, they continue to maintain their buy rating with the target price of 725. They'll review it post the India numbers that will be expected in the next few hours. While InCred, they have a contra view. They like the capex. They're saying if the stock falls because of this capex announcement, then buy it. So that's the contra view that's coming in there. For the time being, the street has no patience when capex goes up for Hindalco in particular. explains why the stock is down 14%.
Right, Nigel, thanks very much for that. The market on the index is picking up a little bit more. 70 points at the day's high is what we have. Phoenix Mills is the next one we're focused on. Sonal is here with details. Sonal. Sonal, take it away. Phoenix Mills.
Well, yes, Phoenix Mills reported numbers, and while the P&L doesn't look so bad, the numbers look good. Revenue growth of 44%. We saw an EBITDA growth of 44%. Margins were absolutely flat at 56%, but the profit growth came in at 70%. What the street doesn't seem to like is the fact that consumption in one of their biggest malls has fallen. In fact, it's down 2%. We'll get into those details. But if we look at the balance sheet as well, their free cash flows have come in at a 5-quarter high, so that number looks good. As I said about the consumption, their overall consumption is up 25% on a YOY basis, but that is because of the new malls that have come by. On a standalone or on a like-to-like basis, the consumption is up in low single digits at 5%, and one of their biggest malls, which is Phoenix Palladium, has seen a decline in consumption to the tune of 2%. So revenues have gone down in terms of mall consumption, and that would say that demand is coming down as well, and that's what the street is concerned about.
All right, thanks a lot for that. Demand is coming down. That's something that we've been hearing for a while. Let's slip into a quick break. On the other side, Lata will get chatting with Amitabh Chaudhary of Axis Bank from the Axis India conference to talk about the quarter gone by and the banking sector going forward. Stay tuned.